Good evening, everyone, and welcome to tonight's Strategy of the Week presentation titled Buying the Dips. In last Thursday's Daily Color Guard report, Steve Chappell alluded to what appeared to be investors getting into position to take back control of this market. Since the November 16th low, the three stages of this rally all have something in common. Once the VectorVest composite crossed above its 40-day simple moving average, that moving average has served as a really solid support level. Let's move right into a market timing graph and take a look. I'll move us from the home page into the market timing graph, and I'm going to uncheck all of our market timing indicators and just keep the price of the VectorVest composite and that 40-day simple moving average. And I'm going to come down at the bottom left and change it to a 6-month graph. We can see that November 16th low here. We can also see that after the market, or the VectorVest composite, crossed above its 40-day moving average, it started to establish a series of higher highs and higher lows. It corrected and fell for 6 out of 7 days here. It was very close to touching that 40-day moving average, and it retraced sharply from it. Fear and greed are always present. Just as it seems that the bears have put a stranglehold on the market, the bulls are waiting in the wings for retail prices, and they've been looking at that 40-day moving average as the perfect opportunity. We can see back here at the end of February, the same thing happened. The VVC fell rather sharply and actually crossed below the 40-day moving average. Now that leads me to my first point. Just because the market touches its 40-day moving average doesn't mean that you jump right in immediately. You always want to wait for an official signal before you start buying again. Now the first signal that you'll get is the primary wave. That's our fastest, most aggressive timing signal. If I come down to the bottom left, we can put the primary wave market timing signals on this graph. Primary wave first turned up off of that retracement on February 28th. So that would have been your first opportunity to start buying stocks again. So as the market approaches and then touches the 40-day moving average, one of two things can happen. Either the market retraces from that moving average and you get the primary wave up signal, or the market falls below it and some more downside is likely. I'm going to extend this graph out a little bit more than 1 year. And you can see what generally happens to the price of the VVC once it crosses above and then crosses below that 40-day moving average. We can see here last summer, once the price of the composite crossed above its 40-day, the 40-day moving average served as a really nice support level. The market went on a nice run here, hit a high on September 14th, started to correct, started to establish lower highs and lower lows, did cross below the 40-day moving average here. You could see we did have some more downside that followed. And again, recent activity here just really drills this point home. I'm going to move us back to a 6-month graph. And just recently too, the market actually closed below the 40-day moving average, but on April 5th, it was actually a bullish day. Let me move us from a 1-month graph to take a closer look. The price of the VVC formed a hammer where it closed higher than where it opened, and it actually closed very close to the highs of the day as well. And in Friday's Timing the Market section of the Strategy of the Week, Steve Chappell talked about this. He talked about the fact that it was a bullish day and that we wanted to see confirmation the next day in order to feel a little bit more confident that the market was once again retracing from that 40-day simple moving average. I'm going to change us back to the 6-month and follow through the next day. We can see that the market did follow through the next day. Now that gave us confirmation of that candle, but we still want to wait for the primary wave up, and that occurred just a few days ago on April 10th. Now this is all well and good to be able to identify a potential reversal, but how exactly should we attack it? The first way is to look at the one-day Derby winners on the day the primary wave turns up. Another way would be to run quick tests from the recent lows to that primary wave up signal to identify the searches the market is favoring up to that point. Either way proves to have merit. And running quick tests of all the bottom fishing searches in the searches bottom fishing group generally tends to have the most success. I'm going to show you option number 1. So let me take this first situation here at the end of last year. The primary wave turned up on December 31st. So let's go look at the one-day Derby winners on that day. I'm going to go into the VectorVest views, dial our calendar back to December 31st of last year, and I'm going to scroll us down to those Derby winners. We can see the one-day Derby winners here. We had energy stocks, silver singles, AC's climbers, rising ETFs, and show me the money long. All had really nice gains that day. Now, instead of taking the top strategy here and running with it, you should set up quick folios to see which of these searches continue their upward momentum. So let's move into Unisearch and do that. Click on the Unisearch tab, dial the date here also back to December 31st. Now energy stocks is in the searches, special searches folder, so I'll open up that folder, double click on energy stocks, and from here all I'm going to do is take these top 10 stocks and put them in a quick folio. So I'll come up to the top right here, I'll select quick folio top 10, I'll give this a name, I'll call it energy stocks. I'll keep all the default account settings the same. The only thing I'm going to make sure I choose here is our purchase type, which is of course long. Click OK. It's going to ask you, do you want to open the portfolio now or open it later? I'm going to show you an example of one more, but I will go to the portfolio section. I'll click on we'll open it later. The next search was silver singles, so we're going to go into the searches bottom fishing group, double click on silver singles, and we're going to quick folio the top 10 of those stocks. Click on purchase type long and click on OK. So that's the procedure there. You just take the top 5 one-day Derby winners and set up quick folios of the top 10 stocks. So let's open up the portfolio now. I'm going to clean this section up a little bit. You can notice we'll have our Surefire Success trading systems here, along with the Chairman's Choice and the Riding the Wave portfolio. I'm going to uncheck the VV portfolios just again to display the ones that I've created. Something you want to keep in mind when trading this type of methodology. These are not long-term holdings. You should treat them as short-term swing trades. And you can manage your portfolio in 2 different ways. You always want to have your stops in place to protect you against any adverse move in the stock. And you can also manage your portfolio as a whole. You know, we have a general rule of thumb around here. Never give back more than half of your gains. Now that goes not only on each individual position, but as your portfolio as a whole. So in the case of energy stocks, we can see it really jumped out of the gate rather quickly. It was up as much as 20.5% on February 19th. So there should be no reason why you abandon this strategy and anything less than a 10% gain. February 19th was right around that next top, and we can see what happened to the portfolio after that. It went down to about 11.5%. So that correction, you may not have abandoned this strategy and gone into cash. But again, if you're up 20%, you should never close out at any less than a 10% gain. Keep that general rule of thumb in place at all times. Never give back more than half of your profits. Now if I go to the next one, which was silver singles, now that didn't work out that well. It started off okay, up about maybe 4%, but it steadily fell after that. The next one-day Derby winner on December 31st was AC's Climbers. Now this was up as much as 13.5% right around that top on February 14th, so you should have never exited this portfolio at any less than about a 7% gain. Next was rising ETFs. Right around that top, it was up about 14%, so you got out at about a 7% gain. We can see that the low here was about 5%, so you didn't feel all of that. And also, giving back 50% of your gains is really the worst case scenario. Once the market starts to pull back and once you see your portfolio start to pull back, what you should be doing is tightening up your stops anyway. So again, giving back 50% is the worst case, is the worst that should ever happen. The last one-day Derby winner was Show Me the Money Long. We can see this is up 21.5% currently, but the most you made here was 15% very quickly, beginning of January, so you should have never exited out at any less than about a 7 to 8% gain. So I just went through 5 searches there. One of them lost money, still about an 80% winning percentage, and that's outstanding. We all know nothing works 100% of the time, But if I have 5 searches to choose from and I know I have a 4 out of 5 chance of making money, I like those odds. Let's move back into the market timing graph. And what I also did was I took the one-day Derby winners on February 28th when the primary wave turned up there. I set up quick folios. Timpson's Tigers was the top performing one-day Derby winner on that day. We can see it's currently up 7.33%. Was up as much as 13% on March 26th. Next was VST Mighty Mites. Now this was up about 5% a few weeks after that primary wave turned up. Now it looked like it started to come out of the gate rather quickly, but the performance has really been wavering since March 14th. So this one didn't work out too well. We'll go to El Cheapos. This was up as much as 16.5% on March 26th. And this one was great. It really exploded out of the gate the fastest, going up each out of the first 6 or 7 days here. So there was plenty of opportunity here to get in. And again, if you're up 16.5%, you're exiting out at no less than an 8% gain. And another thing to point out, you don't have to necessarily choose one strategy. The portfolio manager is not only great for keeping track of your real portfolio, but it's a great tool to identify potential stocks to enter into. You may go through each of the 5 portfolios that you set up and, of course, favor the ones that are continuing their momentum, and also pick and choose and cherry pick some of the best performing stocks from each of those searches. You have enough searches and enough stocks here to choose from. And if I move us back into a market timing graph, and we could stay at 6 months, with today's pullback or today's down day, we're waiting for this same situation to show itself again. We're going to wait for the market to correct back down towards its 40-day moving average. Wait to see what happens from there. Remember, it may cross below and more downside is likely to come, or it may retrace from it. We're going to wait for that first primary wave up signal again, identify the one-day Derby winners, and set up portfolios so that you're prepared to take advantage of the next stage of this rally. This concludes tonight's Strategy of the Week presentation. Have a great weekend.